Why bigger banks became the only answer. It wasn't about ambition. It wasn't even about efficiency. It was about survival. To understand why bigger banks became the only answer, we need to look at how crises reshaped incentives. Each shock revealed the same pattern. Size absorbed pressure better than caution. Scale offered insulation that prudence alone could not. In the early years, banking diversity was a strength. Thousands of institutions spread risk across regions and industries. Failure was contained because it was local, but as markets integrated, local failures stopped staying local. Contagion ignored borders. Small problems traveled fast. Today's system reflects that lesson. Large banks are expected to survive stress. They hold buffers. They have access. They are deeply embedded in crisis planning. Their complexity is not an accident. It is a response to expectations placed upon them. Each crisis reinforced the same message. Institutions deemed too small could fail. Institutions deemed essential could not. Over time, that distinction guided strategy. Growth became protection. Mergers became safeguards. What once looked like consolidation for profit gradually became consolidation for stability. Being large was no longer just an advantage. It was a requirement. And one size became synonymous with safety. The direction of the system was set. As size turned into protection, behavior across the industry shifted. Banks no longer grew only to expand reach or revenue. They grew to meet expectations. Larger balance sheets meant deeper buffers. Broader operations meant diversified risk. Complexity became a feature, not a flaw. Regulators reinforced this trajectory, often unintentionally. Stress tests favored institutions with resources to model every scenario. Compliance costs scaled more easily for large banks. Access to emergency facilities was smoother for those already embedded in the system. Size simplified coordination during crises. Smaller banks faced a different reality. They were subject to many of the same rules without the same flexibility. Their margins tightened. Their options narrowed. For many, joining a larger institution felt safer than standing alone. Consolidation accelerated quietly. Markets followed the same logic. Investors viewed scale as resilience. Larger banks borrowed more cheaply. Their failures felt less likely. Confidence flowed toward size, reinforcing its advantage. The system began rewarding growth not for efficiency, but for survivability. This dynamic created a feedback loop. Growth reduced perceived risk. Reduced risk enabled further growth. Each merger felt justified. Each expansion felt prudent. The system was not designed for uniformity, but it drifted toward it. What was lost was variety. Different business models. Different risk profiles. Different responses to stress. The system became stronger in some ways, but narrower in others. The idea that bigger banks were the only answer did not emerge from theory. It emerged from experience. And experience had taught the system that scale was the most reliable defense it had. The conflict surfaced when this pursuit of size began creating new vulnerabilities. Institutions grew so interconnected that failure became unthinkable, not because it was impossible, but because the consequences were too vast to absorb. As banks expanded, complexity followed. Balance sheets intertwined with markets, governments, and global systems. Managing risk required layers of oversight, models, and assumptions. Understanding the whole institution became harder, even for those inside it. This concentration of power changed the system's psychology. When only a few institutions mattered most, attention narrowed. Oversight focused intensely on the largest players. Smaller risks elsewhere received less scrutiny. Fragility shifted location, not intensity. Critics warned that size itself was becoming a risk. Larger institutions could transmit shocks more efficiently. Mistakes could scale instantly, yet the alternative felt worse. Breaking banks apart threatened uncertainty the system feared more than concentration. Inside boardrooms, the logic was clear. Staying big meant staying relevant. Staying relevant meant staying protected. Growth was framed as responsibility. Shrinking felt reckless. This mindset reached an emotional peak when the system accepted a paradox. The institutions built to prevent collapse had become the most dangerous if they ever failed. Stability now depended on preventing failure at all costs. The question was no longer whether bigger banks were safer. It was whether the system had made itself dependent on them. The climax arrived with acceptance rather than resistance. The system stopped asking whether bigger banks were ideal and started treating them as unavoidable. Scale was no longer debated. It was assumed. This acceptance reshaped everything. Policy was designed around large institutions. Crisis planning centered on their survival. Stability became synonymous with keeping them intact. The system organized itself around a few pillars, trusting them to hold. The resolution is uneasy. Bigger banks do provide resilience. They absorb shocks. They stabilize markets. They coordinate faster than fragmented systems ever could. But that resilience comes with dependency. When the pillars shake, everything shakes with them. Today, American banking stands on this trade-off. Concentration delivers calm. Diversity would deliver flexibility. The system chose calm. And once that choice was made repeatedly, reversing became nearly impossible. The future now hinges on managing that dependency, on ensuring that size does not become complacency, on remembering that protection and risk grew together, not separately. Bigger banks became the answer because the system needed certainty more than choice. Whether that answer holds forever remains the question shaping everything that follows. What the concentration of the banking system also produced, quietly and without announcement, was a shift in the nature of competition itself. Competition, in a diverse system, occurs between institutions of roughly comparable scale. Each has something to win. Each has something to lose. The discipline of that competition produces information about which strategies work, which business models are sustainable, which risks are being priced correctly. In a concentrated system, that competition narrows. The largest institutions do not primarily compete with each other on fundamentals. They compete on scale, access, and regulatory relationships. The disciplines that once sorted strong from weak across thousands of institutions now operate within a smaller range, between fewer players. And the information that competition once generated is generated more slowly, less completely, and less visibly. This matters because information is how markets correct. It is how risks get repriced. It is how unsustainable practices are eventually punished. When the institutions generating that information are also the institutions that have been deemed too large to fail, the information they generate is always filtered through the knowledge that the ultimate consequence, failure, has been removed from the table. That changes the signal, not dramatically, not all at once, but consistently, over time, in the direction of overconfidence, of underpriced risk, of assumptions that the current structure is more durable than it actually is, because nobody inside it has recently experienced the kind of failure that would demonstrate otherwise. The system chose certainty over choice. It also chose reduced information over competitive clarity, and reduced information, accumulating quietly over decades, is exactly the kind of hidden cost that does not announce itself until it is far too late to address cheaply. The system did not intend to reduce its own information quality. It intended to survive, and it did, but survival, pursued long enough at the cost of diversity, eventually produces a system that is very good at continuing to exist and less good at knowing whether continuing to exist in its current form is actually the right answer. That question requires the kind of feedback that only genuine competition and genuine failure can provide. And those are the two things the pursuit of bigness was designed to prevent, which means the system may now be its own least reliable narrator, capable of describing its resilience in detail, less capable of seeing the fragility that resilience has quietly created, certain only of the things it has survived, uncertain by design about what it has never had to face. That uncertainty is not a flaw. It is the honest condition of any system that has optimized for one thing long enough to have forgotten what it traded away. And remembering what was traded is the beginning of designing something better, not by dismantling what exists, but by asking deliberately and without panic what the system would need to look like if it wanted to be both resilient and self-correcting, both large enough to absorb shocks and diverse enough to generate the information that prevents shocks from accumulating unnoticed That balance has not yet been found. But naming the trade-off is how the search begins. And the search matters, because bigger banks became the answer to one question. And that answer is now generating the next one, which no amount of size alone can answer. Why